All right, everybody, we are ready to roll. You've got Joe Johnson and Jimmy Hernandez on here. And thank you, everyone, for hopping on today's training call, Senior Solutions Agency Friday call. And today we're doing a call, and we're going to be covering the Winflex, particularly the Winflex web software. And the reason why we're doing this, I actually had a couple of agents this week that needed some personal instruction on Winflex. So I just kind of thought to myself, man, that's kind of a cool topic. I think maybe we've touched on Winflex, but maybe we really haven't done like an in-depth training. So Jim and I are just gonna kind of give you some nuggets about kind of how to navigate through Winflex and the different products that it's available on. Just a real quick announcement: if you need to order supplies, if you're a new agent, you haven't ordered your starter kit yet, make sure you get with me, and make sure we get you all your supplies ordered. Also, we're also getting a lot of great feedback on the FEX toolkit. Getting a lot of text. A lot of agents have been calling me, helping me get their system set up. So I'm already getting some great success stories of how the FEX toolkit is helping agents put more deals together. They're getting more deals approved the first time, and really just maximizing the agent and the client experience putting those deals together. And just a reminder, it's $114 for the year. We've got a bunch of agents that have already signed up. Everyone who's signing up, I'm giving everybody basically a 10 to 14 day free trial. I actually have not billed anybody as of yet. I want to make sure that you guys are going to use it before I send out the invoices. So if you're using it and you're wondering to yourself, hey, I haven't paid for it yet, don't worry about it. Trust me, you'll get a bill here in a little bit. And if you don't pay for it, we'll turn it off. Not a problem. But don't worry about that part. All right. Now moving on. So today's topic, we're going to be talking about Winflex web. Primarily, I know there's a couple of carriers that use Winflex, but for us in our agency, we pretty much only use Winflex web for the Mutual of Omaha products. Jimmy, I don't know. Do you use Winflex for any other carriers, or is it pretty much exclusively for Mutual?
I would say it's pretty. I'm set up, but I mean, yeah, I'm gonna say I just use it for Mutual of Omaha.
Just for Mutual of Omaha. Okay. All right, guys. Very good. All right. With that being said, we're specifically going to be talking about the Winflex web, which is the the online, the active portal, and you can use it on your laptop, your phone, no matter where you are. But you do need to get registered for it. So you do need to go to winflexweb.com and just click on here where it says register for Winflex. It's going to have you fill out a little form, and you submit it, and then usually within the day or 24 hours, you'll get an email back with your credentials, and you can hop on. You'll be registered for Winflex web. The great thing about Winflex web is that it's always updated. All the current illustrations and interest rates are updated every single day, so you never have to worry about being outdated. And then this is what the homepage looks like when you once you get logged into it. What we're going to do is we're actually going to do a live demonstration. So let me get set up for that. And if you are watching this video, if you're checking this out on a replay on YouTube, if you're not already subscribed to our channel, please, does us a lot of good to have as many subscribers as possible. Gets our message out there, whether you're a senior solutions agent or not. Our goal is to give everybody the value and educate as many people as we can. So give me just a minute. I will get the live demo set up, and we will get going. I get confused on that sometimes. All right, guys, you should be able to see my screen. But Jimmy, give me your input. Like, what products do you use Winflex for, where you want to show an illustration?
Term Life Express, especially if, well, really only if I'm going to do the return of premium option. And the reason why on your app, on your quoting app, it's called ROP, short for return of premium. But the reason why is two things. One, I want to show them the return of premium, by year, right? Because it increases every year, so they don't have to wait to the 30 years. I mean, they could be halfway through at 15 and say, I want to cancel this, and then they'll show what their refund would be.
Okay.
And then the other thing is, and mainly I want to show them that at the end of the 30 years, it shows them not only their total, return of premium, but it also shows them their reduced paid up life insurance that'll cover them up to age 99. And so and I just show them as an option. So it works really, really good for somebody that's young. Let's say you have somebody that's, I don't know, let's say 30 as an example. You do a 30-year return of premium, and then, at age 60, if they wanted to, they just go ahead and take the reduced option. They still have life insurance in force, and they don't have any more premium payments. So that's a really cool way of selling it. Or the other option, like what Joe was saying, is like the GULE, or even the indexed what is it, ULE, or the indexed express?
IULE, Index Universal Life Express.
So one of those two, well, it's going to be a requirement, right? But one other thing too, on both or all three of those products, the term and the indexed and the regular guaranteed fixed UL, is that on this software here, this is where you can find out how much those riders cost. So if you want to do an accidental death rider or add a child rider, which is available on these products, you can see what the cost is. And when you're using the quoting tool on your phone, it doesn't show you the cost, right? And so what happens many times is agents are in the field and they have the application and they see that those riders are available and they check them off and they just assume that they're free and that they're included. And that's not the case. That, if it says optional rider, there's a fee or a cost associated with that. You have to use the software to actually, calculate that cost.
All right, well, let's do this. Let's hop right into it. So guys, the first thing that you want to do is if you're using Winflex and you want to show an illustration to a client, whether you're going to print it out or you could have your laptop, you could do it right in front of your client. You just want to click on illustrations. This is where you set up a brand new illustration. So very, very easy to use. Probably, once you do it a couple of times. Now I want to start a new case. So just click on there. It's going to ask me what company. This can be confusing sometimes, but it's the Mutual of Omaha, United of Omaha. That's the life insurance products. I want to click on that. Now it's going to pop up all my different products. You can see it starts with GUL Express and it has a lot of different products on here. If you want to quote, just as an example here, if you want to quote the final expense product, you're going to need to go down here where it says whole life portfolio, and that will take you to the whole life products. Okay. Now in this example, we want to do what Jimmy was talking about, and we're really going to concentrate on the products today that doing an illustration can have some actual benefit. So we're going to go to Term Life Express, one of my favorite products right here. And I'm going to create a client. This person, I'm just going to put in Joe J. Joe J's a male. What do you say, Jimmy? Maybe 45 or something like that. That's a good age. We'll do standard non-tobacco.
Yeah, that's a good age, Joe.
We'll say we're in the state of Indiana. Okay. Now, policy options. What are our policy options? What do we want to do? We want to solve for premium. Typically, that's usually what we're doing, is that we're on this product, we're going to solve for premium. That what that means is I'm going to put in a face amount and it's going to calculate the premium for me. So let's just put in, let's change it to 100,000. And this client is going to be doing monthly premiums. You can always show annual. Annual's a good way to go sometimes, Jimmy. Sometimes I like, just as a sales tip, guys, sometimes if you're doing a 3-option close or whatever, show the annual premium. And then a lot of times the feedback you'll get, well, how much would it cost me if I did monthly premiums? So it's kind of a little bit of a trial close there to go from annual premium to monthly premium. So here, our client is 45 years old. We're going to do a 30-year term. It's a guaranteed term. Here's the other options that you can do. You can do a 20-year or a 30-year. Riders. Do you want riders? Yes, we want riders. Why? Because we want to show this client the return of premium feature. Okay.
Hey, Joe, can I pause for a second? Go back. You did that so quick. I think most people missed it, where you had to click on riders for it to open up the options. Right there.
Oh, okay. All right. Yeah. So here, if we were here, we click on riders, then you have to actually click the little button there to open up the riders.
Right. And if you don't click it, you're going to be getting frustrated. How come I can't select it? You have to click riders.
Right. Probably the most popular rider on this product is the return of premium, because it's an awesome feature. Just keep in mind, something you want to have in the back of your head: if your client is over 50, if they're 51 or over, don't ever mention the return of premium. You can cost yourself a deal if you forget about that, and you got a client who's 52 years old and you're talking about, oh, the Term Life Express, and you can get all your money back, and then you go to do the illustration and it tells you he's not eligible because it's only good until age 50. Then your client says, well, I don't even want, well, forget it then. If I can't get my money back, I don't even want it. So just kind of be careful. That's a good thing to know ahead of time how the product works. The other thing on this feature is that if your client, you just got to be careful sometimes. If your client if you're going to pitch the return of premium, what you're going to find out is that the disability income is not available when you do the return of premium. See, I'm trying to click on it, it's not available. If I disengage, if I enable this, now I can do disability income. So the Term Life Express has several different riders. The disability income is also a really good product, but it's not available in combination with the return of premium. Now, this call that we're doing is not really meant to be a product call, so I don't, we're not going to get into a lot of details about the different product. The purpose of this call is really just to help you be able to navigate Winflex and how to use it. So let's get back to what we were doing. We want to show return of premium, agent info. It will not calculate unless you put in your agent info. So you need to make sure all the fields are put in there. Get rid of this. Concept, you don't need to worry about a concept. And then over here, you can see where I have my mouse. Looks like I have 0 errors, so I'm good to calculate. All I need to do is click on the calculator, and it's thinking about it. Sometimes it can take 20 or 30 seconds before it gives you an illustration. What's cool about it is that when the illustration comes up, it's going to put it into a PDF file, so you can save it to your computer. You can save clients on your screen. So you see right here, all I want to do now is go over to the PDF and click on it, and it's going to open up my 5-page illustration. Looks very, very professional. As you can see here, it's Term Life Express, 30-year term, Joe J. It's presented by myself. And then this is what Jimmy was talking about. It shows the base plan, what it's costing on an annual basis, $750 a year. And it shows, Jimmy, this is what you were talking about. What is the client actually paying for that return of premium? They're paying $517 a year to have that return of premium feature put into it. And then you get to see all the no cost, the accelerated death benefit, waiver of premium for unemployment rider, accidental damage waiver of premium. This is where you want to educate yourself on all the different free riders. Common carrier death benefit provision, that is free as well. So for this client, age 45, for $100,000 of coverage with return of premium, it's $112.81. And then you can go into all, talk about all the different guaranteed, that the premiums are guaranteed for 30 years. These illustrations are really, really great to view for the agent, because it really kind of educates you on everything. So this is a great page. This is the one I really like right here. This page shows here initial monthly base cost, $46. This is what it's costing you over the 30 years. The total premium return in 30 years, this is what the client would get back. So if you took that $112 and multiplied that over 30 years, this is exactly what it's going to equal, $40,611. So the big selling feature of this particular product is that it's like getting free life insurance. They can have life insurance for 30 years, and at the end of 30 years, they didn't die, they get their money back. It's $40,000, and it's absolutely tax-free because it's just a return of premium. There's no taxes on it because it's a return of premium. The other selling feature, Jimmy, that I like is that it shows the client that if they were basically what their rate of return is. So over the 30 years, they would have to have deposited monthly $46.06 into an investment vehicle that would give them an average rate of return equal to 5.42% to equal the return of premium. So technically they're not getting interest, but it does the calculation to show you what the interest rate equivalent would be. And then here's the other great feature that you were talking about, Jimmy. It shows at the end of 30 years, Mr. and Mrs. Client, you have a choice. You have a choice of either getting that $40,611 back in a check, tax-free, or you can allow Mutual of Omaha to keep your $40,000, and then they will give you a paid-up life insurance policy that's good until your 100th birthday of $64,548 with no premiums due. Okay. How do we do on that, Jimmy? Any other, like, as far as the illustration, anything else that, if we're using this to illustrate Term Life Express, what we should be showing?
That was excellent. I didn't realize about that return of 5.42%. So I learned something new there today. That was awesome. I will say this, as far as like just a little minor sales tip, and I know we're not trying to be product specific, but if you go back up to where those riders were.
Yeah, they also show them here though too. If you scroll down on the like the paid up ones, like which riders are you talking about?
The common carrier benefit. That's what I was going to point out. So this is something that you don't see very often, So when I'm talking with customers, I make an announcement and say, look, this one has triple coverage. What do you mean triple coverage? Well, if you were to die by natural causes, it's going to pay $100,000 death benefit. If you died by an accidental death, well, now it's going to pay $200,000. And if you died by common carrier, which is like a paid fare, such as like a train or airplane, then it's going to pay $300,000, death benefit, triple coverage. So just, that kind of gets them excited when you say that. So I just thought I'd point that out to you. So that's in addition to everything else that this has to offer.
Got it. Yeah, the only thing, now I did not do the accidental death benefit on this one.
Oh, okay. So yeah, so the
But I
common
could.
carrier is free, so you can just, yeah.
So guys, if I hop out and I just go back and let's say I do want to show where it says like riders, what Jimmy was talking about, if I click accidental and let's say I put in $100,000 of accidental and then recalculate, it's going to increase my premium a little bit, probably about 13, 14 bucks a month. Maybe 15 because it's got the return of premium. Let's give it a minute. There we go. That's always a good thing to add too, is the accidental, because it is a pretty inexpensive rider. So now our premiums are only, it's only $131 a month, and we've got $100,000 natural causes, $200,000 of accidental, and like what Jimmy was talking about is the common carrier, it's going to be triple coverage. And because we increased the premium a little bit, they're going to get a little bit more money back. Now it's $45,000 of return of premium, and it would increase the reduced paid up to $71,000. So that looks it's a really inexpensive rider to add on. So guys, this is just another example of when you would use this. Let me see what else is on here. Accidental.
Hey Joe, I wanted to touch on something real quick. On the reduced paid up, if you notice, it was actually increased, right? And that's
Correct.
because this particular example, he's a younger individual. As the person, I guess, gets older, I think it is a reduced paid up, correct? Or is it younger? I'm sorry. Well, it swings. There's a that swings, and so in some cases, the reduced paid up life is lower than the original death benefit. Oh, it is lower. I'm sorry. Yeah, because it's 100,000. I don't know what I was thinking here. I'm sorry. So it is a reduced paid up. As you work with somebody that's younger, in some cases, it'll be the same or a little bit higher than the original face. So just kind of keep that in mind.
Yeah, it does. Yeah, it has. Yeah, you're right. It has to do with the how old they are and then their estimated life expectancy. The other thing too that you can play around with is changing, and we'll show this real quick, is showing the client the difference between doing a 30-year and a 20-year. Now, here's the thing that's counterintuitive is that normally when you quote term insurance, the lower term is always less expensive. But with return of premium, it's actually more expensive because the client is getting their money back quicker. So let's do that. Let's just show that one scenario real quick. So let's keep in mind, what are we paying on this policy? It's a 30-year return of premium, and it's $131 a month for 30 years. Let's do this. Let's change it. I'm going to click out. I'm going to go back up. I'm going to go to my policy options, and I'm going to change it to a 20-year return of premium. Make sure I still have all that in there with the 100,000 of accidental. Now we're going to calculate. Let's see what it does, Jimmy. And this is where having an illustration comes in handy, because then you can print two illustrations and you can show them side by side the difference between a 20-year and a 30-year. The benefit of doing a 20-year is that even though the premiums may be more, the total premiums will be less. They'll actually put less into the policy because you're paying for 10 years less, even though the premiums may be a little bit more. Let's see, what was our premium amount for the 30? It was
131.
131. What did I do wrong? I don't have the return of premium in here.
I was gonna say, Joe, I don't know if I think Mutual of Omaha changed it. I don't think you can do the 20-year return of premium anymore. I think it's only 30-year now.
I think you're right, based on their age. Yeah, you used to be able to do it.
Mm-hmm.
That's weird. It allowed me to click on it. It's not telling me that there's an error. Yeah, but it certainly didn't calculate it, did it?
No. Yeah, because I noticed when I'm using my phone app to quote Term Life Express,
Yeah.
the 20-year guarantee with ROP is no longer there.
Got it. Okay. All right. So guys, this is the, how you would use Winflex for the Term Life Express. The other thing that you can do is if you're working with a client, especially if you're face to face, you can toggle between different products. So as an example, here, let's go back. Let's change this back to the 30-year. Okay, so let's say we just showed the client the 30-year return of premium, what a 30-year Term Life Express, $100,000 worth of coverage, and you want to show the difference of maybe comparing a Term Life Express to the IUL Express. Well, all you need to do is just go up and click, and you can change the product. I want to change it to Index Universal Life Express. So I got my same client in here, Joe J, age 45, Indiana, solve for. This is where you're going to solve for. Now, typically, if you just want to show a basic illustration that is maximizing the face amount, typically what we're going to do is we're going to do easy solve. Now, what you'll notice is if you're using the calculator on your phone, the only solve that you can do is easy solve. Okay, so when you do easy solve, that's doing a level death benefit, and it's going to calculate a premium that is not, it's designed to keep the policy in force until age 120. Okay, so let's just take a look at it. Let's see what the difference is. I'm going to do easy solve. I'm going to do a face of 100,000. Don't need to worry about disbursements. Index strategy, guys, you really don't need to worry about that. You can take a look at it, but just know it's automatically going to default to the 1 year 100% participation. And it's calculated at a 5.8% interest rate, and it has a cap of 9.25, which is pretty good. Basically, if you want to know what that means, that means based on the 1 year calculation of the S&P 500, it's been averaging 5.8%. The cap of 9.25. What that means is that if in an annual point to point, if the S&P 500 did, let's say, had a growth of 15% for the year, the client would get 100% participation up to 9.25%. So they would get a 9.25% return rate for their calculation. Policy options, it's automatically going to default to a level death benefit. Riders, we're not doing any. Here, let's click off the riders. We're not doing any riders. Report, agent, Okay, that all looks good. It says I have 0 errors, so I'm good to calculate. So this is pretty cool. So, especially I do have an error. What is my error? Okay, click over here where it says errors. First year total premium. Oh, okay. So I have a total error with the premium. Let me click back on where it says client and the solve for face amount. I think I wanted to do, okay. What happened, guys, is I had it on face amount, and I should have had it on premium, because I want to know what the premium is for 100,000. So that fixed the problem. So face amount is 100,000. I'm going to figure out what the premium is. Let me redo it. I think it was trying to calculate a premium of $100,000 a month, which not going to work. Time for the calculator, so it's calculating. The biggest thing I can tell you guys is that when you get the illustration for the IUL and you see, oh my God, it's 27, 28, 30 pages long, however long it is, don't let that intimidate you. There's really only a couple of pages you really need to worry about, okay? Okay, so here we go. And this is going to be a very basic illustration. It's a 30-page illustration, guys. The only ones you need to really worry about is you can take a look at the second page. This shows right here, we're starting out with an initial death benefit of 100,000, and the plan premiums are $88.89. That's a very affordable premium for $100,000 of coverage to have permanent life insurance. As you scroll down, you will see all the different, if you want to highlight the different riders, my advice is don't get caught up in all these extra pages. Get down to where, like here, accelerated death benefit for chronic illness, accelerated death benefit for critical illness, tells you everything, gives you a description of what is a critical illness, ALS, kidney failure, life-threatening cancer, major organ failure, heart attack, stroke, major burns, AIDS, dementia. It really gives you a lot of great living benefits. Okay, so that's a great selling feature to go over with the illustration. Next is that you're probably just going to scroll down. Let me get all the way down to page 24. 24 or 25, that's where everything really starts, where you want to do most of the selling. Right here, this page right here. So this shows your client age 46. This is the annual outlay of $1,067 a month, or I'm sorry, a year, or $88 a month. And you look over here where it talks about the non-guaranteed. This is the assumption of the product performing at 5.8%. This left-hand column, accumulation value, this shows how the policy is accumulating value. And you can see here we're calculating a level death benefit of $100,000. The way this policy works is that you can think of it this way, it's the policy is being calculated to show the client the lowest premium possible to keep the policy in force for the longest period of time. So when you're showing an easy solve, it's not really designed for maximum cash value. It's designed for maximum length of the policy, if that makes sense. So if you can understand how an IUL works, it's building cash value. So as the client gets older and the premiums the premiums are going up, it can start taking money out of the cash value, so the client does not realize any increase in premium. And you will see how that works. So So we can see here at age 65, it has $20,000 of cash value. Now, you know, in 20 years, if the client decides, hey, I don't need life insurance anymore, certainly they can pull out their 20 grand. They can cash out if they want to. They just don't have any more life insurance, or they could borrow money from it if they wanted to. And we have separate, like I said, this is not to explain how an IUL works. We have other training videos for that. This is really to show you how the software works. But as you can see, let me just, at age 85, it's got $62,000 of cash value. What you want to look for when you're doing an IUL to make sure that it's not going to lapse, you want to make sure is that when the client gets into their 80s and 90s, that it has adequate cash value, that the policy's not going to lapse. So you can see here, you can give it the eyeball test, and you can see age 85, man, it's still accumulating cash value. This policy is in absolutely no danger of lapsing. Let's age 95, it's still building cash value. So as you can see, that Easy Solve is really designed to have enough cash value that you never have to worry about the policy lapsing. Even at age 100, if they make it to age 100, it has over $110,000 of cash value. And you can see here that now that some of the cash value is starting to go over to the death benefit. They would actually have $111,000 of death benefit. So that's kind of how the Easy Solve works. Easy Solve is, think of Easy Solve as just a very, very basic illustration. But I would like to show you guys maybe how to use Winflex to do maybe something a little bit more complicated. Jimmy, anything you want to add about the illustration or talk about Easy Solve before we move to some different illustrations?
Well, I'd like to say that, Joe, you said it earlier, but I just kind of want to, re-emphasize it, is that when you're doing this Easy Solve, your purpose or your objective is to provide a death benefit, not the supplemental retirement with cash value, right? So you don't want to pitch it that way. As Joe mentioned, they can take that cash value out if they wanted to, but really and truly, this is designed to stay in force. So if you're looking for a permanent policy that's going to stay in force and it's going to be a low competitive rate, this is a great solution for it. So I mean, I just want to kind of re-emphasize that.
Yeah, just as a comparison, you guys, if you were to take this client who's 45, let me just do this on my phone real quick, and you can see the difference, how competitive this is. Like if you just compare this to a GULE as an example, let's see, Guaranteed Life Express. It'd just be easier to do this on my phone than changing it. Let's see, our client is 45, male, non-tobacco. We did $100,000 of coverage, right?
Mm-hmm.
Guaranteed to age 120. Yeah, on a GULE, the premium payments for 100,000 are $107 a month. Where with the IUL Express, we're coming up with $88 a month. And based on this illustration, this policy is in no danger of ever lapsing. Okay, so let's do this. I'm going to exit out of here. Now, what I've been getting questions on a lot are Joe, how do I show, I've got a client, I want to use the IUL Express for a retirement vehicle as an example. Well, there's, quite a few different ways of doing it. The biggest thing I can tell you is that it's going to be helpful for you to just go in and spend a lot of time just kind of playing around with the software. But I'm going to show you a couple of techniques that I use. One is, let's go to insured. We're going to keep let's say we're going to keep the person at age 45, solve for, but now I got the client that is more interested in cash accumulation and not so much worried about just having a death benefit. Well, easy solve is not the way I want to do it, okay? So what I want to do is I want to go in, I want to change it from easy solve, and I'm going to change it to face solve, and I'll explain why. So I've got a client, let's say, who I'm going to put in the premiums. As an example, let's say I got the client that says, you know, hey Joe, this is how much I can afford to set aside. I can put away, you know, whatever it is. It could be $50 a month. It could be 100, 300, 500. In this scenario, I'm just going to say this client can easily afford $200 a month. Okay. Now they're 45 years old. One thing that's kind of cool about this, if you click on the schedule, like I put in the premium amount of 200, I can click on the schedule and actually I can type in for how many years they're going to pay on it. Let's say I got the client that only wants to pay on the policy for 20 years. I can go in here and I can type in 20. Or let's say they say, well, you know, I want to pay on it until I'm 67 years old. Another way you can do it, you can type on age, and I can just type in, hey, they want to pay on it until they're 67. See how easy that is? And then there's other increments I can do here as well. Let's see, face amount. Okay, now you want to click on face amount, and there's different options you can do. You can do solve for cash value, which is a good option, or you can do minimum face, maximum funded premium. This is the one I like. Okay, so again, just to re-emphasize, I've got a client who's 45. Jimmy, did you want to add something before I move on?
No, keep going.
Oh, okay, I thought I heard you. Okay. Hopefully I'm not going too fast. What's great is this is being recorded, so you can go back and watch it 100 times and rewind it. You can see how we're doing this. So in this particular scenario, I clicked on the age. The client is in agreement. He can fund the policy till age 67, and he can afford $200 a month. Okay. I'm not going to worry about disbursements. I'm not going to worry about index strategy, policy options. Actually, there is one thing I would like for you to change. Okay. And that is go into policy options, and I want you to change the level death benefit to an increasing death benefit. Two reasons why. Reason why is because now when you show the illustration for the death benefit, it's going to show an accumulated death benefit that's going to be the face amount plus the cash value combined. The other reason why I'm doing this is because if you do increasing death benefit, it actually gives you a higher monthly premium, which allows you to put more money into the policy if it was just a level death benefit, which in return, when you're using this type of calculation, it will actually maximize the cash value. Riders, I'm really not worried about any riders. I'm not going to add in any riders to it. Reports, don't really need to worry about that. Agent info, we already have that. Concepts, you don't need to worry about this one either. Just click none for concepts. Says here I got 0 errors. Let's see what we come up with. Again, we got a client. He's 45 years old and he can afford $200 a month. It's thinking about it. It's going to come up with something good. Here we go. Click on your illustration. There you go. It's going to show you right here. That's going to give the client an initial death benefit of $64,286 and premium outlay $200 a month even. Okay. And again, it's going to go over all the great riders with the policy. That's the one thing about this IUL Express. It does have really good riders. Like I said before, the accelerated death benefit for chronic critical illness, terminal illness. Now from here, honestly, I want to scroll down. I want to get down to the illustration. That's where the magic is. Page 24, that's where the fun starts. Okay, right here, page 24. So as you can see at this $200 a month, look how much different this illustration is versus the one we did before with the Easy Solve. Client is putting in $2,400 a year. That's $200 a month. And even after year one, you can see it's already building up cash value. And even just after 10 years at age 55, it already has more cash value than what he put into it. You can see here, totally put in $24,000 worth of premiums. It's already got, after 10 short years, it already has more cash value than what he put into it. And then you can also see the death benefit. This is a huge selling point. If that client were to pass away, instead of just having the the $66,000 of death benefit, they're going to get the benefit of the $25,000 plus the initial death benefit. So actually would have a payout of over $90,000 of death benefit. Let's keep scrolling down. As you remember, we did this so the client would only pay into the policy until age 67. So if you look over on the left, you can see here, age 67 until his 68th birthday. So actually, in the way we did this, I mean, you can always go back and change it, but it's doing it up until the client were to turn 68. And you can see here they put in a total over those 24 or 23 years, they put in a total of $55,200 of their own money. But at the end, at age 68, it's already got $90,000 of cash value, and the death benefit is $158,000. So this is where you can show the client at this point, they can start taking distributions, start taking policy loans against the policy to supplement their income. And Jimmy, this is where your expertise would come into play of whether or not, does the client at this point, do they use the money in their policy to supplement their income, maybe for the benefit of delaying their Social Security by a few years so they can maximize their Social Security? I'm not sure if everyone is aware, and maybe even the clients are not aware, is that every year you delay your Social Security, that Social Security benefit is actually increasing. And then if you had a policy like this, that perhaps maybe you could use the cash value in your policy to help supplement your income so you can delay Social Security distributions. Would you want to talk about that a little bit?
Man, Joe, I love the way you approach this. There's so many angles that you can take this. So just depending on your client's needs. But you're right. I would think at this point it's probably premature to kind of talk about supplementing the retirement, the Social Security with these funds, only because when you're writing this guy up at 45, that's the furthest thing from his mind, right? But if they were closer to 62, then that definitely would be a great topic, and you would want to do the calculation for them. But I want to take a different spin, Joe, and kind of like just do a little sales tip right here. Okay.
Okay.
I do a presentation. My whole webinar and presentation, it's called Zero Tax. And so, man, perk up here real quick, because I'm going to show you how to make some money. So let's say, for example, you have somebody that has a 401k. Let's say this individual's 45 years old. and he has a former 401k with a previous employer, and that money's just sitting there, right? And most of the time they want to do something with it. So we talk about zero tax, and basically what I do is I teach the individual how they can take a conversion into a tax-free product. This would be one of two that I recommend, right? So the UL, IUL. So let's say, for example, you show the person, okay, we're going to go ahead and take out $2,400 a year, and you're going to pay taxes on it, and you're going to use that to fund this policy. So now it's not even coming out of their checkbook, Joe. It's just coming out of that old 401k. So they're funding the policy. It goes into this. It's building up cash value. It's doing a lot of things for them. One, it's providing a death benefit. It's providing all those living benefits, and now it's creating a whole bunch of cash value. When they get to that age of 68, now they don't have to make any more payments, premium. They've already converted everything out of that old 401k. They paid their taxes on it. Now the money's here, okay? And they have some options. They can either take out this, like let's say you have the option of taking a stream of income for the rest of your life, and it'll calculate that for you. Or you can take it out as needed in chunks, or you can take it out all at once, or you can just leave it untouched because maybe you don't need to touch the money. You're not making any more premium payments, and it's just going to keep accumulating cash value because of the compounding interest, which is adding to the death benefit. So you can see if this person makes it to age 85, there's $194,000 in it with a $259,000 death benefit, and it started out at a $64,000 death benefit.
Right.
So I mean, there's tons of flexibility, but you hit it right on the head with, like, could this hold somebody off? So like, let's say you're talking to somebody that's a little bit closer to retirement, and they're telling you that they want to take the early retirement and get early Social Security at 62. Well, the problem with that is it's a permanent reduction, and they're also permanently reducing their spousal benefit. So if we can supplement that income that they're going to get from Social Security out of the life insurance, then yes, we can hold you off a few years, maybe make it to 67 or even 70, which is the max that you can fund out on Social Security. So if you can say, we're not telling you you don't have to continue working, you can retire if you want to, but let's just not take that Social Security money. Let's fund it with this life insurance. And like I said earlier, there's a ton of flexibility here, but really and truly, look for those opportunities where somebody has an old 401k or old IRA or something like that that's not really doing much for them right now, and they're wondering what to do with it. You can teach them to convert it to a tax-free vehicle. I don't know if you want to expand on that a little bit more, but I will tell you this. Let's say they never convert it, they leave it in that IRA, and let's say they never touch it, or let's say they do touch a little bit of it, but the bulk of it they're going to leave to their kids. Well, under the current tax laws, an inherited IRA or inherited 401k, it's the same thing, qualified plan, now has to be taken out in 10 years. And the beneficiary has to pay the full taxes on it over a 10-year period, right? Well, if they go ahead and take the time to convert this over a period of time into a tax-free product, they can get that $259,000 death benefit 100% tax-free. So if you take it from a zero tax kind of approach, and really hit home on it, you'll hit some home runs. And really and truly, Joe, this is how I get those really big annual premiums on something like this.
Yeah, absolutely, dude. That's a great concept. Well, guys, there's a lot more that you can do with Winflex. What I would recommend, this is just kind of giving you an overview. But if you're working, the best thing to do is actually work on some cases. maybe even write yourself up. Why don't you write yourself up on an IUL? I can help you design the case. But there's a lot more that you can do with this. A lot more different, strategies and different ways of figuring it out. This is just kind of giving you some insight. The best thing I can tell you is get registered for Winflex, watch this video, go in and play around with it. And then if you've got some, as you're working on cases, get with myself, get with Jimmy, and we can really show you how to design a case that's going to maximize it for your clients. But man, that seemed like it was a really quick hour. I didn't think it would go by this quick. Jimmy, any other little tidbits before we sign off?
I do have a tip for everybody. So like if you're new to this software, if you've never done it before, what I would recommend to do is call Mutual of Omaha Sales Support. Tell them what you're trying to accomplish and have them walk you through it. And that way you kind of learn. And if need be, if you need an illustration really quick, you can tell them what you want and just tell them to email you the illustration. And that way you can, meet with that customer real quick. But again, when you have time, you want to have them walk you through it, show you how to do it, take really good notes, get proficient at it. And that way you can structure it, the way you want. But that's really about it.
All right, man. Well, everybody have a great weekend. Thanks for hopping on the call. Like I said, man, we got this recorded. We'll get it published. We'll get it on our YouTube channel. This way you can, watch it a whole bunch of times and really get proficient with WinFlexWeb. All right, Jimmy. Well, have a great weekend, man.
You too, Joe. Take care.
All right, man. God bless everybody. Take care. Bye-bye.